Right. Let's just dive straight into this explainer. Look, if you've ever stared at a screen completely full of candlesticks and felt like the market was just a chaotic, unpredictable mess, well, you're definitely not alone. Today, we're going to look past the standard charts, totally wipe away all that retail noise, and uncover how large institutions, the true heavyweights of the financial world, really move the market. We're breaking down the inner workings of ICT Smart Money Concepts.
So ask yourself a pretty serious question. Are you trading with the institutions, or are you their liquidity? Honestly, there's a massive risk in trading blindly based on gut feelings or basic retail patterns. The hard truth here, if you don't actually understand institutional behavior, you're probably just providing the exact liquidity they need to execute their massive orders. Our goal today is to totally flip that dynamic.
Here's our roadmap for today. First, spotting institutional footprints, then avoiding the retail trap, confirming market trends, nailing down precision timing and entries, and finally, protecting your capital. Let's get going. All right, Section 1. Spotting institutional footprints, or finding tracks in the snow. We can't literally see the institutions trading in real time, right? But we can absolutely see the massive tracks they leave behind.
Now, the absolute engine of market structure is a concept called displacement. Imagine a sudden, aggressive, forceful price movement. We're talking long, wide-range candles with almost zero wicks and basically no pullback. That, right there, is displacement. It's the undeniable proof that smart money has officially entered the chat. They're leaving a giant footprint on the chart simply because they're moving way too much volume to hide. And when they move that fast, they kind of break things. Specifically, displacement leaves behind what we call fair value gaps, or FVGs. Because the price moves so aggressively, it created a market inefficiency, literally a gap between buyers and sellers. And these gaps, they become magnetic targets for future price action. The market absolutely hates an imbalance, so price will naturally gravitate right back to these FVGs to rebalance the order flow before launching in its true intended direction.
Moving on to Section 2, avoiding the retail trap. Pump fakes versus real breakouts. This is exactly where everyday traders get absolutely crushed. Let's look at a head-to-head comparison here. A market structure shift versus a liquidity grab. A true market structure shift, or MSS, means the trend is actually changing. How do you know for sure? Well, it features a full-bodied candlestick closing past a key level, totally driven by that displacement we just talked about. A liquidity grab, on the other hand, is basically a pump fake. It's just a quick, sharp dash past a higher low, usually just leaving a wick. Its only purpose is to trigger retail stop losses before the market immediately reverses right back into its original trend. Building on that idea, let's compare a break of structure, a BOS, to the market structure shift. An MSS introduces doubt, right? It breaks structure against the prevailing trend. It's basically saying, hey, the institutional order flow might be reversing. But a break of structure? That breaks structure with the current trend. It reinforces your confidence that the existing momentum is super healthy and that sellers or buyers are still firmly in the driver's seat. Okay, Section 3, confirming market trends and finding the exact turning points. Because seeing the shift is one thing, but how do we confirm it?
We can break down our execution zones into two main categories here. On the left, we've got the order block. This is the precise origin point where institutions first started accumulating their massive positions. You obviously want to enter there because, well, that's where the smart money entered. But look on the right, we have the breaker block. This is a previous structural swing high or low that actually failed. It was broken impulsively, and now that failed level serves as a mitigation area. It becomes a completely new turning point for a sniper entry in the opposite direction.
So, to put all this into practice, the methodology looks for a change of character, or ChoCh. It's a pretty strict four-step process. First up, you wait for a massive liquidity sweep on a higher time frame, like the 1-hour chart. Second, you zoom all the way down into the lower time frame, say the 1-minute chart. Third, you watch for the very first break of the last internal swing point. That right there is your ChoCh, proving the order flow is surgically transitioning. And finally, step 4, you execute your entry at the newly formed fair value gap or order block. Moving right along to Section 4, precision timing and entries. We've talked a lot about what is happening on the chart. Now we really need to figure out exactly when and where to strike. Listen, in the ICT methodology, time is literally just as critical as price. If you look at the 24-hour cycle, the Asian range is generally just an accumulation phase, basically building up liquidity. But the real magic? That happens in the kill zones. The London kill zone hits at 3 a.m. Eastern. Then we've got the volatile 9:30 a.m. New York Open, followed immediately by the New York kill zone at 10 a.m. Eastern.
Seriously, if you're taking lower timeframe setups outside of these high-volume windows, you're practically begging to get chopped up by random retail noise.
Which brings us directly to the famous ICT silver bullet strategy. It's incredibly straightforward, but man, it requires supreme discipline. Step 1, you literally just wait for the price to breach the previous hour's high or low, and this has to be strictly inside one of those kill zones. Step 2, you use that breach to establish your bias by looking for the fair value gaps or order blocks it leaves behind. Step 3, determine your targets using daily liquidity pools. And Step 4, you execute within that precise time window. Simple as that.
Now to get even more surgical with our entries, we layer on the Fibonacci Optimal Trade Entry, or OT. But wait, you can't just throw a Fibonacci tool on random wicks, okay? You must have an inducement and displacement first. Once you actually have a valid market structure shift, you draw your fib from the absolute start to the end of that impulsive expansion range. Your high probability entry, the true institutional sniper zone, is going to sit exactly in the 61.8 to 78.6% retracement window. That is where you strike.
All right, final stretch, Section 5, protecting your capital. Because honestly, spotting footprints and calculating the perfect entry time means absolutely nothing if you don't know how to protect your money from market slippage.
Let's talk about high-probability stop-loss placement. You basically want to hide your stop-loss using the exact same institutional protection tools we just learned about. If you enter on an order block, place your stop safely below or above it. If you're entering on a fair value gap, tuck your stop right outside the first candle of that three-candle formation. Or for maximum structural safety, place it at the extreme structural swing level, the absolute lowest low or highest high that kicked off the whole move.
Now pay really close attention here, because the methodology considers this a golden rule. Always leave a buffer for the spread. I'm serious. If you put your stop loss down to the exact pip of the structure, you are going to experience the agonizing pain of a premature exit. The market might sweep your level by a tiny fraction of a pip just due to minor price fluctuations or your broker's spread, only to immediately turn around and run perfectly into your profit target. Leave a buffer.
Let's quickly recap the strategic pitfalls you absolutely have to avoid. First, mistaking a wick-only liquidity grab for a real market structure shift. Huge mistake. Second, trading isolated 1-minute setups without a higher time frame narrative backing you up. Third, trading outside of the kill zones. Remember, volume is your friend, so don't trade in a vacuum. And finally, getting totally overwhelmed by low-probability fair value gaps. Not every single gap is a setup. It has to align with the broader institutional flow.
So here's my final question for you to ponder today. You now know what the institutional footprints look like. You know where they step, and you know exactly when they step. But do you actually have the patience to sit on your hands and wait for them? Discipline is the final piece of the puzzle here. Study those charts, wait for the kill zones, and trade safe out there.